The global sports gambling moat did not just experience a minor crack this quarter. It faced a structural paradigm shift. During a massive World Cup cycle, prediction markets quietly captured an astonishing 27% of total betting volume. This was not a slow migration of retail capital. It was an overnight reallocation that caught institutional analysts completely off guard. Companies like Kalshi are no longer niche platforms for political junkies. They are scaling into direct, systemic competitors to legacy sportsbooks. The traditional gaming model is facing its first true existential threat in a decade. To understand why this matters, we must look at how legacy operators generate revenue. Companies like DraftKings and Flutter Entertainment rely on high-hold models. They act as the house, setting the odds, taking the risk, and charging a premium fee. Their structural moat is built on high marketing spend and proprietary risk management engines. For years, this model was considered highly insulated from outside disruption. But that is only part of the story. Legacy systems rely on taking direct counterparty risk against their own users. Here is where the structural friction begins. Prediction markets operate on a completely different framework. Instead of acting as the bookmaker, platforms like Kalshi function as pure, peer-to-peer derivative exchanges. They do not take counterparty risk or set artificial, biased lines. They simply match buyers and sellers of yes or no event contracts. This architecture eliminates the traditional house edge entirely. By operating as a low-cost clearinghouse, they offer users significantly better pricing. This structurally alters the unit economics of the entire consumer betting landscape. Now let us look at the actual numbers driving this trend. During the recent World Cup, traditional sportsbooks saw their active user growth begin to mature. DraftKings and Flutter experienced a flattening of their net gaming revenue per active customer. In stark contrast, event contract volume experienced exponential scaling. This indicates that incremental consumer discretionary dollars are actively rotating away from traditional platforms. The capital is flowing directly into transparent, exchange-traded products. This volume shift is not a temporary seasonal anomaly. Here is where the margin metrics become interesting. Legacy sportsbooks operate with a structural hold rate of roughly 8 to 10%. This means they capture a large slice of every dollar wagered. Prediction exchanges, however, operate with fractional fee structures. This puts immense downward pressure on traditional operator margins. If consumers realize they can trade the exact same sports outcomes with near-zero transaction fees, legacy sportsbooks will be forced to compress their own take rates to remain competitive. The next signal comes from how traditional gaming management is reacting to this challenge. Public filings show executives are quietly attempting to preserve their market share. They are doing this by accelerating the rollout of house-banked microbetting features. DraftKings is heavily investing in live, in-game parlays to create a more gamified, high-margin product. But this strategy does not address the core consumer demand for transparent pricing. Management's current defense vector appears focused on retaining recreational players while conceding sophisticated high-volume traders to prediction markets. This defensive stance is also altering capital allocation priorities. To keep customer acquisition high, traditional operators must maintain elevated marketing spend. This constant promotional expense acts as a heavy drag on free cash flow. Meanwhile, prediction market platforms are growing organically through viral social distribution. They do not need to offer massive promotional credits to win market share. This structural efficiency allows prediction platforms to scale volume at a fraction of the marketing cost of traditional books. Now look at how the broader macro environment is accelerating this trend. High inflation and elevated interest rates have squeezed middle-class consumer discretionary income. Customers are becoming hypersensitive to transaction costs and unfair pricing. Prediction markets appeal directly to this new, financially literate demographic. These users view event contracts as an asset class, not a casino game. The convergence of finance and entertainment is creating a brand new market segment that traditional operators were never designed to serve. This structural convergence is redefining the competitive landscape. Traditionally, DraftKings and Flutter only competed against each other for market dominance. Today, they are competing with commodity-style trading platforms. These exchanges offer continuous, real-time price discovery on global events. This has forced traditional operators into a difficult position. They must either lower their fees or risk losing their highest value, most active customers. The era of comfortable duopoly in the online gaming sector is officially over. That leads us to a bigger question regarding terminal risk. The regulatory landscape for prediction markets is highly complex and volatile. Legacy operators have spent years establishing state-by-state regulatory moats. They are actively lobbying regulators to restrict prediction exchanges. Meanwhile, platforms like Kalshi are fighting intense legal battles with the CFTC to secure their right to offer event contracts. A sudden adverse regulatory ruling could easily halt the momentum of these prediction platforms. Regulatory risk remains the single most critical variable in this thesis. Beyond regulation, prediction markets face their own structural vulnerabilities. Because they rely on a peer-to-peer exchange model, liquidity is everything. If transaction volumes drop during non-major events, the spreads widen. This makes trading highly inefficient for large institutional participants. Traditional sportsbooks do not have this issue because they always act as the market maker. This means legacy operators still maintain a massive liquidity advantage for daily, non-major sporting events. Prediction platforms must find a way to maintain consistent liquidity outside of major global events. Looking forward, the market is likely pricing in a major shift in capital allocation. Over the next 12 to 18 months, we expect to see a permanent reallocation of capital. Sophisticated retail traders will continue migrating to exchange-traded event contracts. Traditional operators will likely see their premium valuation multiples compress. This is because their high-cost, high-hold model is less competitive in a mature market. The long-term valuation of these legacy companies will depend on their ability to integrate exchange-style features directly into their platforms. From an institutional portfolio perspective, this analysis suggests a clear shift in risk. We are placing legacy gaming operators on a trim consideration. Their high marketing spend and vulnerable hold rates present a challenging near-term risk-reward profile. The threat of fee compression from low-cost exchanges is a fundamental headwind. Investors should monitor whether these companies can successfully transition to a more capital-efficient model. Until they address this competitive threat, their upside potential remains structurally capped. Something important is happening here. The rise of prediction markets is not just a trend. It is the natural evolution of financial derivatives merging with consumer entertainment. The platforms that win in this new era will be the ones that prioritize low-friction, transparent pricing, and robust peer-to-peer liquidity. The legacy house always wins model is being challenged by a far more efficient market mechanism. This structural transformation will continue to reshape the global consumer betting sector for years to come. This shift in market structure is exactly what we track here at SR Money News. If you want to stay ahead of the structural trends shaping global capital, make sure to subscribe to the channel. Turn on notifications so you never miss our deep dive institutional research segments. Leave a comment below with your thoughts on how prediction markets are impacting traditional sportsbooks. Thank you for watching, and we will see you in the next analysis.